I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, Fidelity drops a bombshell. We'll talk about what's going on at the big money manager and see if experts' predictions are going to come true or if Fidelity's big bet is going to fall flat on their face. And speaking of falling flat, the Fed is on the verge of making a major move as they get nervous. We'll show you what could cause the Fed to cut rates far sooner than even they think. And speaking of the unthinkable, a major country is facing an outright catastrophe. We'll show you why they've got to make a big move, and soon. And speaking of big moves, if you're a technical trader and you love bull flags, I'm going to show you our sponsor for today's show, Pluri Inc. They're back. You can find them on the NASDAQ under the symbol PLUR, and their stock is forming a monster of a bull flag that we could show you based on the recent news could kick off a move as much as 40%. You're not going to want to miss out on this opportunity at all. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Fortune, where we picked today's story up with a headline. A BlackRock and Fidelity ETF bombshell is now triggering a massive 75 trillion Bitcoin price prediction. If you can only imagine that would send, of course, price to the moon. Let's take a look at what's going on here. This is a big bet Fidelity and BlackRock are making because Bitcoin price has added around 350% since crashing to a recent low of 15,000 per coin, largely thanks to a fleet of spot Bitcoin exchange traded funds taking Wall Street by storm. The question now is going to remain is this thing going to the moon, or is there something in the economy that could shift in a major way and cause everyone to sell? Now, after Coinbase revealed its backing of BlackRock's $5 trillion by 2030 game changer, famed stock picker and Bitcoin bull Cathie Wood has hiked her price prediction, betting a coming Bitcoin price surge will give the coin a market cap of a whopping 75 trillion by the end of the decade. Love to know what you think. Weigh in the comments below. As Wall Street giants BlackRock and Fidelity have bet big and emerged as the two largest of the new Bitcoin ETF issuers, raking in assets under management around 15 and 9 billion respectively, as what we see as a surge of retail buying start to drive the price higher. But one thing that no one seems to be asking here, because the direction everyone believes is up, but is there something underneath the economy, the financial system that could change in a big way that could cause all these buyers to turn into massive sellers? And we think Bitcoin has miles to go, as according to Cathie. We're at the very beginning of really putting in place the financial ecosystem native to the internet and disintermediating all of the toll takers we'll see, because rather than solely attributing Bitcoin's current fluctuations to the impending halving, well, with Bitcoin's retracement potentially looming and historical patterns indicating potential turbulence, we advise investors to tread carefully while exploring opportunities amid the uncharted territory of the 2024 halving, which is one of the reasons we bring to you our sponsor today's show, Pluri. Check them out on the NASDAQ under the symbol PLUR. Again, you're a technical trader. This bull flag is amazing. Stay tuned to the end of the show, because right now everyone's betting on Bitcoin breaking out. But the one question that I want to challenge everyone, even if you're bullish on the coin, to ask, is the economy strong enough? Because what gets people to sell is when they need money. And what could cause that? Well, let's check this out. As retailers now turn to extreme bargains to lure shoppers as consumer spending underwhelms. And what happens in the economies, particularly when you head into a recession or a financial crisis, people buy things that they want to hold, such as Bitcoin, things like gold. Problem is, when your house payment comes due and you don't have a job, well, the problem is you got to sell along with a lot of other people. And we can see things are breaking down around the world as the industry is still reeling from a disappointing Christmas season, the most critical period of a year for shops. In fact, in the UK, total sales grew a mere 1.7% in December, compared to about 7% a year earlier. But the U.S., well, it's about the same here, where consumer spending started the year weaker than expected, while inflation was higher than forecast, helping explain the shopping pullback. But that's not just the only reason. We'll give you some others that contributed to defaults in the retail sector of the U.S. high-yield bond market, soaring past 5.4% in the last 12 months, nearly double the 22-year average of 2.8%, suggesting there are problems all over the place, and this has got the Fed's fingertips all over it. But we'll talk about in a bit what could cause the Fed to capitulate far sooner than anyone even thinks. As consumers' budgets are now strained, they'll be looking for money. Maybe they'll sell Bitcoin. We'll see. And as we note, distress at budget change is partially because discounters' core customers, low-income households, are cherry-picking what they purchase to save as much money as possible. They're avoiding the discretionary items, only buying what they need, which carries a lower margin for retailers. This is a problem because what we're seeing is plans to focus more on extreme bargains at stores like Big Lots to attract customers and stem losses. In fact, yesterday we talked about how Darden restaurants they're not going to want to become extreme discounters. We believe, based on where the economy is headed, every retailer, every restaurant is going to be desperate to get customers in. We'll show you why, because when we look at retail sales here, there's a number of issues that are affecting consumers, and one of those is the fact that total compensation growth is slowing down. Now, here in a week or so, we'll get the next non-farm payroll report, but for the moment, look at advanced retail sales. This is in blue against total compensation. This is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And what are we seeing? A deceleration here. So paychecks are effectively shrinking against inflation at a time when consumers want to see bigger checks. In fact, the government keeps telling them, hey, your wages are going up. The problem is the government can't see that hours are getting cut. And sure enough, what happens as you see decelerations in total compensation, again shown in red, what happens is retail sales go down, and that is a dangerous sign, because what it ultimately starts to lead to is further unemployment and persistent unemployment claims as retailers, wholesalers, even restaurants look to lay off. And here you can see from the economy's perspective, again, we're making the case why people are going to have to sell things they don't want to. They're going to need money. You can note that as advanced retail sales go down, here we see continued claims in red. That obviously coincides very well with those people going on and staying on unemployment. Well, their spending power declines. And right now, what do we see? This persistent continued claims around 1.8 million. This number goes higher. Well, that could cause the Fed to back off and cut in a big way, because we're already hearing from Powell. He's getting a little nervous that maybe he went too far. As Fed's Powell's ready to support job market, even if it means lingering inflation. And well, if you lose a job market, you don't have to worry much about inflation at all. And while the Fed is waiting to be sure its inflation battle is won before cutting rates, an unexpected weakening in the labor market could also warrant a policy response, he said, this after its two-day policy meeting, suggesting that the Fed chief is starting to get a little concerned about what's going on in the labor market, and for very good reason. You know, we talk about, as particularly from the Fed's perspective, of how they're really worried about inflation. Well, as you're about to see, they're really more concerned about the job market. And if we look at the federal funds rate now, shown in blue against continued claims, that still in red, what we can notice is continued claims start to pick up. The Fed does take notice, and they tend to cut rates. In fact, you'll note that may be the specific driver the Fed's really focused on, instead of inflation, is what we hear about at every meeting and every news article and what they seem to talk about. But if you look behind closed doors, you look at the relationship between continued claims and the funds rate, suggesting that perhaps any further increase in continued claims could get the Fed now to cut rates far sooner than they expected. Their predictions, of course, for some cuts later this year, we've been saying they're coming sooner than later, because if you lose the labor market, well, inflation becomes the last of your problems. Because sure enough, we look at the consumer price index now shown in blue against continued claims. That's still in red. And what happens as people get on unemployment and stay on unemployment, particularly in a high interest rate environment where their debt service costs are elevated and inflation is running strong, they lack the spending power because, of course, their wages get cut going on unemployment to put and spend it in the discretionary side of the economy. Ultimately, that leads with a lag, of course, to a big decline in consumer prices, suggesting if consumer or continued claims get out of hand here, again, consumer price index is going to be the last of the Fed's issue, because what they're going to have a problem is going into the next election. Well, of course, the job market's going to fall apart, and that would be a big problem for our incumbent president as he seeks to get reelected. And Powell said he didn't see any cracks in the job market for now, but some economists are not so sanguine. They point to marked increases in joblessness in a number of states, continued declines in temporary staffing, and, as we've been saying on the show for a long time, a continued reduction in working hours. Regardless, Powell and his colleagues are well of what looks to them to be a solid labor market can quickly turn sour. Historically, once unemployment starts climbing, it goes up by a lot as companies follow each other in announcing layoffs. It's not so much that as they start to see the demand for their products and services go down. Of course, we know that employers have to deal with higher costs due to inflation from the prior cycle. They do everything they can to cut their expenses. But ultimately, if demand isn't there, there's one thing they can cut, and cut a lot of, and that's employees, and they do it. We're strongly committed to bringing inflation down to 2% over time, but we stress over time, suggesting now the Fed believes they've gone too far too fast. That's good news. Well, at least it seems like it for President Joe Biden if we can get inflation down to 2%. But if it comes on the back of a labor market disintegrating, well, chance of getting reelected goes somewhere close to zero. As he seeks a second term, because voters already have a dim view of his handling of the economy, a big rise in joblessness would only fuel that perception ahead of November's election. And we've noted in the past on the show that incumbent presidents almost never get reelected during a recession. Based on what Powell's doing, it looks like we'll be in one by then. And here we can see, of course, what is driving this economy into the downward spiral has everything to do with the Fed inverting the yield curves and money curves, constricting the creation of credit and the growth of money in our economy. Here we can see this on this chart as the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. And since commercial banks create money when they lend, well, when they get tighter lending standards and don't want to lend, that's less money in the economy. And that means, of course, your growth targets start to get ratcheted back. There isn't even enough money to support the labor market. You can see here against continued claims as banks start tightening lending standards. Well, a lag, well, next thing you know, the economy starts to go. Here we can see banks are still on net tightening standards, albeit at a slower pace than before. But you watch, if the labor market goes, the Fed has no choice but to cut, and cut in a major way. The timing of this, again, for President Biden is actually not good at all. It's not good for the economy, and it's not good for everyone who's piling into the equity market. As Morgan Stanley now notes, Wilson, he says the stock rally will end if profits dip. Well, what will bring profits down? Well, that means people aren't spending. What would that cause? Why? Well, it would be a recession. Of course, as further multiple expansion in the U.S. is likely dependent on an upward inflection in earnings expectations, as everyone's buying into not only just a bull market, but a booming economy. It's hard to justify the higher index level valuations, he says, based on fundamentals alone, given that 2024 and 2025 earnings forecasts have barely budged over time this period. And when you look, of course, at the labor market, which the Fed is now starting to worry about, here you see corporate profits after tax in blue, as investors are betting big on corporate profits and earnings surging higher. The problem is, as more and more people get on unemployment, we saw this with, of course, retail sales data, demand goes down, corporate profits fall. Of course, we know when that starts to go, the equity market follows in suit. The challenge here is we have a lot of people piling in at the top. Again, coming back to the initial story here of if families are running out of money, what their face is, you've got to put food on the table. You've got to keep your house intact. You got to sell the things you don't want to. Will Bitcoin continue to surge? I'll leave you weigh in the comments, because one thing that's not surging, that's the yuan, putting Beijing in this point that they're going to have to do the unthinkable. As yuan rebounds, as a PBOC sends strong message of support via fixing, we're going to make the case that this fixing isn't going to last much longer, because what they're going to need to do is devalue, as today's fixing is a clear signal from the authorities that they do not intend to allow further weakening in the yuan, as last Friday's moves were an overreaction by the market, and today's fixing is firmly aimed at correcting that perception. We think, of course, this means Beijing's going to have to devalue. It's going to send interest rates down, put the Fed in a position where they're going to have to cut in a major way, and that does not bode well for the economy. But one thing that does bode well, that's for your trading account, was we got a massive bull flag forming on the stock of our sponsor for today's show, Pluri Inc. This one could send, and you're going to see that. I'll show you the chart. Their stock price up as much as 40%. They've got some news that just came out. Let's take a look, and you can find all the information in the pinned comment and description below. They're on the NASDAQ under the symbol PLUR, because Pluri, there's where they bring technology. It comes to life as they transform cells into solutions that promote global well-being and sustainability. Now, we talked about this recently, that they offer robust cell expansion technology platforms that create new cell-based solutions. One of those being Pluri's sustainable cell-based coffee is addressing critical challenges revealed in International Coffee Organization market report. This is a big deal. Check this out. Their cell-based coffee aims to reduce price instability by moving coffee production into the lab and eliminating the effect of climate change and adverse weather conditions. They recently announced the launch of their cell-based coffee with its proprietary cultured coffee product business as part of Pluri Agritech vertical. And the company's cell production method grows coffee quickly and reliably in an environmentally sustainable, cost-effective, and tightly controlled, fully automated manufacturing process that's highly scalable, which is one of the catalysts we see that buyers are stepping in the stock, getting ready to squeeze out these shorts and send it even higher. Again, find them on the NASDAQ under the symbol PLUR. We'll take a look at their chart in a moment, as Pluri's proprietary method for producing coffee aims to produce a better product with regards to taste, texture, scent, and sustainability. That from Pluri's CEO. Now let's check out the stock, because I want to show you what a bull flag is. If you're not familiar, this is when the stock shoots up and then consolidates. And what you see is sellers coming in at lower and lower points, buyers stepping in below, and then next you know, it starts to break out, those shorts get squeezed, and the stock just rockets higher. Let's take a look at this 90-day chart of Pluri. Again, you can find them on the NASDAQ on the symbol PLUR. Here's that flagpole. I wanted you to see that. Here's, of course, the flag. It's consolidating as, of course, sellers are driving it down, buyers are coming in, and right here it's about to break above that upper end of the flag. That means price likely to go higher. Where could it go? Well, it goes right into that next supply zone. How do you know it? Because stocks trade in between zones. You'll notice there aren't a lot of buyers or sellers in between here. A move into that upper supply zone from this bull flag could realize a potential and quick 40% return. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.